Narratives are important to investors. They help frame the buy and sell decisions we make and give us the grounding we need to stay the course when times get tough. Unfortunately, some are just plain wrong. And if you're invested due to a story that simply doesn't hold water, it can cost you. Joining me for the first time on the Money Show MoneyMasters podcast is an expert with critical intelligence on the energy sector and the narratives that apply to it. If you're wondering what's next for crude oil and natural gas, or curious about the impact of EVs on petroleum demand, or just looking to better understand what geopolitics mean for the sector, you will not want to miss this chat. My guest is Anas Alhajji, managing partner at Energy Outlook Advisors. Anas, thanks for joining me. Anas, thank you so much for taking some time out here to talk about the energy markets. I know they're obviously a key focus for a lot of investors out there. For those who haven't seen you at a prior Money Show event or may not follow your great work on Twitter, can you talk a little bit about your background, sort of how you came to follow the energy industry and what you're doing now with Energy Outlook Advisors?
Yes, since I was undergrad, basically, I wanted to be in this field. I was influenced by one of the professors, and then I got my master's and PhD in the field from the University of Oklahoma, which was ranked number one, by the way, in this field at that time. Then went to academia. I taught at the University of Oklahoma, I taught at Colorado School of Mines. As you know, both of them are heavily associated with the oil industry. Then moved to Ohio, taught there for several years. Then I came to Dallas and worked for a private equity, which is a well-known in the area here, NGP, Energy Capital Management. I was their chief economist for several years. Then left in 2016, started on my own, worked a couple of kind of advisory positions with some OPEC members. And now basically I'm wearing several hats. One of them is the consulting slash advising, etc. And then we have another publishing entities. Basically all of them are focused on energy, with one of them basically is in Arabic, which is the only energy focused media outlet in Arabic, and we have 32 employees, 21 journalists, and the significance of this is that the Western journalists who are based in Dubai or other places, whatever they report based on the stories they think they are useful from their point of view. While that's not the case for us, because for us, basically, we understand the US market, we understand the European market, we understand the Middle Eastern markets, and we bring stories and analysis that do not exist anywhere else.
Oh, clearly in a market like energy, the global dynamics are incredibly important, even in this era where the U.S. is producing so much more than it has in the past. A lot to unpack. So why don't we just start with the oil price outlook? I mean, we're here, WTI trading around, $60, Brent a couple bucks higher. Why? And if you look at the longer term perspective, I mean, the oil prices have generally been sideways to lower for the better part of a year plus now. What's driving that, and how do you see that evolving as we get further into the year?
The main issue here is that companies can deal with higher cost. Companies can deal with higher tariff. In fact, that's what CEOs and companies do all the time. They deal with the change in cost. So we have no problem with the tariff and the cost of the tariff. The problem we've been having is that no one knows what Trump will do tomorrow. It's the confusion that Trump created in the market that is affecting the market. Changing the goalpost all the time is causing the chaos in the market. And if you are an investor or you are a company, you want to spend a couple of $1 billion on a project, you don't do it right now. You wait. And if you are even, or you want to buy something for your business, for your company, or even for your home, most likely if it is one of those expensive items, probably you will wait until you see what's going on. So as a result of that, a recession is expected because of this. And with recession comes all kind of declines in prices of commodities, including oil. So if you look at the oil market alone, without these issues, the oil market support, or the oil market fundamentals today support higher prices than what we see today. But if you want to insert the risk of the recession and the confusion in the market, then what you see basically is justified.
Yeah.
Which
So
means
essentially
that
a demand side story here, not a gusher of new supply from drill baby drill or anything like that. Yes.
well, drill baby drill is not going to happen. And if you don't mind, I'll explain this quickly to the audience because this is a
Please.
very important point. And we did this study late last year, so this is not related even to the tariffs. The fact is, President Trump promised us drill, baby, drill, and to increase oil supplies. But the first fact is he cannot have it both ways. He cannot have his cake and eat it at the same time. He cannot have lower prices and increase in production. But this is not his problem. The problem is, if you look at what's been going on between 2015 when he was a candidate and later on when he was president, let's say in 2017, the situation changed substantially, which means that 2017 or to 2025 is not 2017. I'm going to mention some examples just to kind of to rest this point once and for all. And at that time, in 2015, interest rate was zero. Even when it increased in 2017, when we have this sharp increase in production, it is 1/3 of what it is now. We all know that the shale industry floated on free money.
Yeah.
That is not the case today. So that interest rate is number one. Number two, the structure of the industry changed substantially. If you look at the number of companies, it declined substantially. You look at the number of workers, it declined substantially. And why it did decline? It did decline because the model changed. We all know that it was the small and medium-sized companies that started the shale industry. It wasn't the oil majors. The oil majors came in late. And the model for the smaller companies was very clear. You go to a private equity or you go to a bank, borrow the money, you create that team, and you drill, baby, drill. Your objective is to prove reserves, increase production, regardless of cash flow. That's why people, since 2010, been saying, this is a business that will go under. This is a business will go bankrupt. It did not go bankrupt. We know that the shale industry created more millionaires than probably any other industry. And how it did that? Well, that's what you do. You prove reserves, you increase production, and then you sell to the bigger fish or bigger whale. And you make your money at the end. Those who are looking only at cash flow, they don't see the millions and the billions that be made after the sale. So the model historically was drill, baby, drill. But after the majors came in and bought most of those guys, there are no bigger than the majors. So the model of drill, baby, drill is no longer there. So that's the second point, change in the structure. The third point is extremely important. We all know that shale production reached its peak during the Biden presidency. But that increase comes with a fact that the Trump administration has not realized yet, which is the decline is higher than ever with the record production. We know that the decline rates are very high in shale, but as you keep increasing production, the amount of decline is huge. So right now, for example, we need at least 600,000 barrels a month to replace just to maintain production flat. You multiply that by 12, you get the millions of barrels that we need to replace a year just to maintain production, which means that most of the investment will go just to maintaining production. And that's what the Trump administration missed. Of course, there are other factors, but these are the major factors. And then you add to them to the tariff right now, and the tariff on steel and tariff on aluminum and all that stuff. You know, if there is no steel, there is no oil industry. If there is no aluminum, there is no LNG industry. And we did a study about 2 months ago, and part of that study basically, or the conclusion about LNG, that all those new plants that are being under construction or planned to be built, their costs will go up by 11 to 12% because of the tariff, which we are talking about a billion to 2 billion per plant increase just because of the tariff.
Yeah.
Which means that at least if they are not going to be canceled, at least they will be delayed because of that. The oil industry itself, the tariff is going to increase cost probably by about 4 to 5% because of the tariff.
Yeah.
So you add that to all the other things that I mentioned earlier, the interest rate, the change in the industry structure, the decline rates, etc. And you can see that we are not going to see this large increase in shale. However, I am not that bearish on shale either, which means we have people who are talking about shale production will decline substantially and U.S. oil production will decline from 13 to 9. I don't believe that. Shale is resilient. The idea that I remember this vividly. Every year we have people coming to us telling us we are at the core right now. And then the following year say, well, we just moved to the new core. And they keep, and always you have, so those who are saying that this is tier one and that's it, well, yeah, it is, but we don't know. We need really to wait farther to confirm that it is tier one, because we've been hearing this year after year, and we always find a better tier than the one we are in.
Anas, I'm glad you mentioned LNG, because I did want to talk about that side of the business here in the U.S. I mean, clearly, you look at just a simple chart of what natural gas has done up until very recently, price performance relative to oil, and it's almost like a mirror image. So is that all, was it mostly weather related that natural gas has been doing very well? Is it LNG? Is it both of those factors plus something else that I haven't mentioned? What's been driving the differential in performance between natural gas in the U.S. and crude oil?
So we have the natural gas market in the United States. And as you know, we price that, most of it is priced by Henry Hub, although there are other hubs. And then we have the LNG, the liquefied natural gas, which is all mostly exported outside the United States to Europe and other places. And what we've seen historically is LNG prices were way higher than the US natural gas. It's not only because of the cost of liquefaction and transportation. They still, even if you count all of that, there was a wedge in between. U.S. natural gas prices historically been low simply because of the shale revolution. And what the shale revolution did, we do have two types of shale. We do have shales that are kind of gas and gas liquids, and we do have gas that is coming as associated gas with oil, like in the Permian. And the problem we ended up with, when oil prices, say in 2022, reach almost 130, producers basically want to drill any well, anywhere. And what differentiate shale wells from other conventionals is that the amount of gas in them is higher. So as you drill for oil, you get more gas, and you dump that gas on the market regardless of the price of gas. And that's why we end up sometimes with negative prices for natural gas, because the objective of the producer is to make money out of the oil, not out of the gas. And because of that, we are wasting a lot of resources, whether flaring it or just getting rid of it in one way or the other. So this dilemma of associated gas kept gas prices very low in the United States for a very long time. And as long as oil prices are good enough for the producers, they will keep dumping that gas on the market. That is why Putin wants to kill U.S. shale. That's why Putin wants to limit U.S. shale, because Putin lost to U.S. LNG in Europe. And if he can limit U.S. natural gas, then U.S. LNG will not be as big in Europe, and then he can regain market share. It's not the Saudis or OPEC who wants to limit the shale. It's really Putin, because of the gas, not because of the oil, because of this dilemma of associated gas. So when natural gas prices went up recently, it went up for two reasons. The first reason is the weather, which you mentioned. And the second reason is we have expansion in the LNG industry and required more gas. And natural gas prices in Europe were very high. So it was more attractive basically to ship that gas outside the United States than to sell it in the United States, although prices went up.
When you look at the World Bank, I think they just came out and predicted, commodity prices in general performing poorly because of demand issues tied to tariffs and trade. Their forecast, if I'm not mistaken, was energy prices dropping 17% this year and another 6% next year. Does that seem realistic to you? Is that too bearish? What are your thoughts on sort of the forward outlook here?
The problem we have, I mean, generally speaking, and that's what we missed by analysts and the media in general, that we have economics and we have natural resource economics. And even at universities, we teach those as two separate courses, and their concepts are completely different. Our problem with natural gas or with natural resource economics, it was different from industries, for example. And industries basically you can just kind of like slow production lines, you can control production lines, you can turn off some of the factories, etc. But what distinguishes natural resource economics, including oil, is that most of your cost is upfront. So you go drill a well, that well could be dry and could be rich in oil. And what happens is if it's dry, you cannot recover your cost by just refilling the well. And no one will buy it from you. But if you build a factory, if you go bankrupt, you can sell the assets. But that's not the case with an oil well, with a dry oil well. The dry oil well basically is gone. That's it. Even if you get commercial quantities, basically, most of your cost basically is upfront, and your operational cost is very small. So what happens is when prices drop, what matters in this case is your variable cost, which is the operational cost, not the total cost.
Yeah.
And therefore, in extractive industries, you keep reducing even when prices go down. And that causes more problems. That's why we see more volatility with commodities than other things. Because, for example, I'm just making this up. I don't want anyone to take those as for granted. Let's say the operating cost in the Permian is $18.
Yeah.
So if prices drop to 24 and everyone is losing money, but at 24, they will keep producing. And people will be wondering why they keep producing and they are losing. Well, because they lose more if they shut down. You need prices to go below 18, like we've seen in 2020, to shut down. And that's kind of specific to the natural resources, which include oil in this case.
Anas, you're going to be joining us for our symposium in Las Vegas. I know we're fortunate to have you in Dallas recently, and it's still a few months out. The working title we have now is Energy Market Outlook, Debunking the Narratives. Are there one or two narratives out there that viewers of this need to be aware of in the energy space if they're investing or looking to invest in energy?
Definitely. I mean, one of the narratives is the climate change narrative, and this is extremely important. I'm not talking about debunking climate change or the ideas, not at all. I'm talking about the policies themselves. Just look at what happened in Spain and Portugal and part of France yesterday. They have this complete blackout. People been screaming at elevators because they got stuck in elevators. They got stuck at metros, in stores. Stores couldn't open their doors because customers got stuck inside. It just like complete chaos. And it just happened that we are right now on the 29th. So on the 16th, okay, just like almost 2 weeks ago, the Spanish government and others were bragging that they had 100% power generation from renewables just 2 weeks ago. So you can see where the story is going.
Yeah.
But this is one of the issues that I want to focus on is the impact of electric vehicles. Because the issue is not the number of electric vehicles. The hype is on the impact of electric vehicles. People do not realize this, basically, that seriously, we have 30 million electric vehicles right now on the streets in China. By how much? What is the replacement of gasoline? If you assume all of them gasoline, what is the replacement? People will be shocked when they know that the replacement is very small.
Honestly,
oh,
please go ahead.
That's number one. The other one is, look at Norway. 90, look at the media. The media basically focuses on sales and tell you 95% of this sale. Well, that does not matter. When it comes to oil demand, what matters is the number of electric vehicles on the road, not the percentage of sales. And if you look at that, even in Norway, it's still small.
Yeah.
It's not big. The other issue is when we did a study on Norway and we found out that the replacement is not 1-to-1. And this is important. It's 0.6-to-1. And one of the explanations basically is that families have more than one car. So the number of miles driven a year is distributed between the gasoline or the ICE vehicle and the electric vehicle. And they keep the ICE vehicle, whether diesel or gasoline, they keep it for long distances. And they use the electric vehicle within the state itself or within the city.
Yeah.
And one of the ironies is after all those sales in Norway, what did the Norwegian government ask the public for after all this expansion? They found out that congestion increased substantially in the cities, and the cost of congestion is very high. And they start asking people to leave their electric vehicle at home and take public transportation.
Well, honestly,
Why you have to go through that loop? Just go directly to the public transportation.
I'll tell you, I mean, again, having had the opportunity to see you speak before and share some of these important tips, it's gonna be a great experience, and I'm glad that you're gonna be joining us in Las Vegas.
Well, if you don't mind, I'm just going to
Please.
add one point because this is very important.
Sure.
There is no way you can make electric vehicle without petrochemicals, and petrochemicals come from oil and gas. Why electric vehicles need petrochemicals? Because the companies realize that these are very heavy when it comes to the weight. So you compare ICE, two sisters, one ICE and one electric, the electric is way heavier. So to reduce the weight, because in some countries, the taxes on vehicles are on the weight. So to reduce the weight, they have to use some composite materials instead of steel and other things. And therefore, there is more petrochemicals and plastic and composite materials in electric vehicles than a usual car, and therefore the consumption of oil in making the car is higher. So we have what we call the direct impact, which is the replacement of gasoline.
Yeah.
And then we have the indirect impact, which is the making of the vehicle itself. Regardless, the final point on this is that if you look at China, right now, as we speak, despite the decline in economic growth, 58% of generation in China is coal, which means that those 30 million vehicles that are electric vehicles, many of them are coal vehicles. And I seriously think, if you don't mind, I'm going to switch the discussion just a little bit here. I seriously believe that it's not only about climate change. Now, China has been working on reducing emissions in big cities, because those of us who went to China know very well how polluted the cities are.
Yeah.
So regardless of climate change, they need to clean up their cities. But China, if you look at what they are doing, and you look specifically at the last 2 years, they are increasing their capacity, solar and wind capacity. They are increasing their power generation capacity from coal, and they are buying oil because it's cheap. And they literally told their companies, go and spend money on exploration and production within Chinese borders. And they were able to increase production of oil and gas substantially. Why? Simply because China realized that there will be either a war or sanctions on China.
Yeah.
And therefore, they need to ensure that they have enough energy sources, because if the US and its allies block the Malacca Strait, 80% of the trade of China basically 80% of the oil trade to China basically will be blocked. So what China is trying to do basically is, it has nothing to do with the climate as much as for national security. They are trying to increase the production of all energy sources, including coal. So people are saying, well, they told us that they are going to stop using coal. Well, when it comes to national security, whether the US or Canada or or Germany or others. We already seen it. Who cares about climate change? Climate change basically does not take priority when it comes to national security. And that's what we are seeing in China today.
No, Anas, again, I appreciate you sharing some insights on some of the narratives that are out there and some of the implications for oil and gas markets and the energy sector overall. If you're watching this, again, as a reminder, you're going to have a chance to see Anas in person, get his insights there at the Money Show Masters Symposium in Las Vegas. It's July 15th to 17th at our all-new venue, which is the Caesars Palace Resort. If you've been there before, you know it's great. If you haven't, you're definitely going to want to come check us out in July. Anas, thanks again for joining me, and we'll be in touch in a few months.
You're welcome. Thank you. Thank you very much.